All right, we'll wait for people to start filtering in.
Sounds good.
Actually, I'm kind of worried that the real estate AI conference might be competing a little bit with us because I just gave my talk over there, and I know I saw a handful of the people that are normally in this group over there.
Where
So
where was that? Was that a virtual
it
conference?
was a virtual conference. Yeah.
Okay.
I think they'll come over though. We have our meeting every day at the same time.
Yeah. And had you done that conference before, or was that the first time participating?
I think it was the first time the conference had been
Okay.
had happened, but it was my first time, definitely.
Okay. Okay.
Let's see.
Are you in Oregon right now, Daniel?
Yep. Yeah, I tend to do all my meetings from here.
Yeah.
I prefer I prefer Zoom oftentimes over going out to conferences.
Yeah. Yeah. Well, I think I shared with you when we caught up that, I was in Portland for quite a while. So
Hmm.
I definitely I was there last summer and made it out to the Oregon coast, which I always love,
Yeah.
especially in the summertime. It's just beautiful. So, but I
Just
do.
so you are aware, and I know we're talking casually here, but we are live on Facebook, LinkedIn, YouTube, and Twitter.
Okay. So in other words, be careful what I say. Is that what you?
But no addresses, no,
Yeah. Yeah. No.
welcome to all of you. I see that people are beginning to filter in to the Alternative Investing Club. Hey, if you guys were just at the Real Estate AI Summit and heard my talk over there, can you put into the chat that you were over there? Just say hi in the chat, or say hi or AI. Say AI in the chat, and that'll be unique. Keisha Lewis says, so happy the Teams link finally worked. Oh, I don't think we're on Teams. Glad it's working for you. AI. William was there. I know Glenn was there, and I saw Mario and several other people I know. But just so we can start this going here, can you put in the chat where you're from? Just say hi and the location you're coming in from. And we will liven this up a little bit as we're waiting for more people to join. We're passing 40 people right now. We usually get around 80 to 100 to 120 on a really good day. Fort Worth, Texas. Uh-oh. Oh, is your Tor, is your colleague Cade?
Cade might be joining us. Yes. We'll see.
Okay. He's a speaker? Or she?
No, I'm gonna handle it all. I just had invited him to join if he could. So
Okay. Do you want me to put him on the screen or not? He joined as a speaker.
that's okay. We'll call him up to stage if we need to. How about that?
Okay. All right.
I don't want to put him on the spot too early. So
Hey, Anita. Hey, Priya, Robert, Satish. I see the usuals here. So I don't think I know you. Welcome here. Robert Clark. Anybody that this is their very first meeting? Out of curiosity, if you heard me over at the Real Estate AI Summit and this is the first time you're joining, let us know in the chat as well. All right. Things are a little slow on the pickup today. But we'll get started in just a few minutes. If you guys have a topic that you want to talk about, please put it in the chat. I always get my speakers based on the feedback that you provide. So if you want to hear about a particular topic, put it in the chat. I will let you know that Tor's topic, I think, is going to be fascinating. I've never heard this particular real estate strategy before. I think it's, Tor, are you the only one doing this, or are there others doing it?
we are. So there's 5
Okay.
other major players doing the origination side of these assets, but we are the only ones that are actually bringing it direct to investors as an investment opportunity. So
Okay.
yes, you are correct. That's why you probably have not heard it until now.
And I won't step too much on your introduction, which we'll get to in a moment here. But for those of you who don't know, Tor is one of the founding members of CrowdStreet. Founding partners, I guess you would say.
Yeah,
Hello, Ain.
that's dating me, Daniel.
In a good way, though.
Yeah.
All right. We will kick it off in just a moment here. I want to go through the announcements really quickly. First of all, I want everybody to know that I'm joining up with Lauren Burchrell, who has been a speaker here before in the past. She spoke on investing in storage, although I think it was probably 2 years ago. She and I are going to be teaching a course on how to raise capital going from your first 0 to 1 million. It's going to be a free course, 1 hour, once a week for 4 weeks. And so if you're interested in learning how to raise capital, we will be at capitalraiseschool.com. However, I will warn you that I just found out that the form to sign up is broken currently. So I do have a Google form I could send you to, or you could just wait till tomorrow or my follow-up email and sign up then. But just to let you know. The next thing I wanted to let you know is that we're going to start using the club fund more with some of the upcoming speakers that are coming in. Tor Steen, I'm going to be introducing him as a club fund speaker tentatively. And that is that I like his business model and I like the projected returns. But Tor will probably let you know that, or at least he told me yesterday that they're still finalizing their legal documents. And so I wouldn't recommend somebody as a club fund speaker until I've read and reviewed their legal documents. And it's something that I would invest in personally. And also to say, this club is just an investor club. We're not a registered investment advisor. And I do need to pull up my little disclaimer for that, but I don't have it handy. We're not a registered investment advisor. We provide a platform for people to talk about their own experiences and their own investment strategies. We neither recommend nor not recommend a particular person or a particular business. Having said that, we do have a club fund, the Alternative Investing Club Fund. And there's a possibility that Tor may be a part of that. The speaker for next week will be a part of that. They actually have a very innovative model where they buy medical debt from veterans and first responders and restructure it, help them get them back onto a path to reclaiming their credit and provide an investor return. And then in 2 weeks, we have another group, which I'm still doing due diligence on to see whether there'll be an educational talk or a club fund speaker. But they invest in airplanes and airplane engines. They purchase them and lease them back to major airlines, and that's how they create their funds return. So some interesting projects that are coming up here at the Alternative Investing Club. Hope you stay tuned for it. With that, I'm going to introduce Tor. Welcome to the group here. It looks like we've got a good quorum coming in. So I will turn it over to you and add your slides as well.
Thank you, Daniel, and thanks for the invitation to join the club today and share a lot more about how to invest in home equity, which again, as Daniel mentioned, is a new space. But a little just quick snippet on me. As he mentioned, I was co-founder and CEO of CrowdStreet. We were one of the pioneers of online real estate investing for accredited investors. And what I really get passionate about is how we can bring alternative investments, specifically real estate types of assets, to everyday investors, right? Traditionally, they've been kind of closed private markets available to just the largest institutions. So like at CrowdStreet, where we grew it from an idea back in 2013 to the largest commercial real estate investing platform. I was excited when I met John Green, the founder at Nada, about 2 years ago, and joined last summer as CEO. Nada is revolutionizing real estate investing with what we call home equity agreements, and I'm going to get into a lot more details about that. There's two sides to the platform. You can think of Nada, the holding company, as also Nada, the acquisition side, which is a top originator of home equity agreements for homeowners. And then HomeShares, which is the brand you see here, is an experienced investment platform for investors. And we'll get into more details about that. So just like Daniel, I'm going to give a quick disclaimer. We are not a financial advisor. I'm not selling a product here. This is for educational purposes only. So the agenda, I'm going to do an overview about what are home equity agreements, because this is a new thing. They've only really been in existence in the public for about 2 years now. We'll talk about what does that mean for investors, and how do they compare to public REITs? Public REITs tends to be the easiest thing to compare them to, but we could compare them to direct commercial real estate investing or other assets. We'll talk about some of the trends that are favoring HEAs, and then finally, how to invest in HEAs. I usually like to take questions as I go, but I'd like to ask today, since there's so much content in here, and a lot of times I get questions that it's literally in the next slide. If you can hold your questions till the end, or if you want to put them in the chat window as I'm going, please feel free to do that. We're actually going to have a little survey halfway through the presentation. So I think this is probably an obvious thing for everybody on the in the club today. Why do investors love real estate? Well, it's a stable, dependable asset class. It has historic long-term appreciation, and it's a great hedge against inflation. But we all know there's common challenges and pain points when it comes to investing in real estate. It tends to be complex. It's inaccessible, it's time-consuming, and there's many times a management reliance. So in comes home equity agreements. So what's the kind of the dictionary definition? It's a secured contract where a homeowner receives cash today in exchange for a share of their home's future value. It's unlike a loan because there's no monthly payment that the homeowner needs to make, and NADA gets to share in the home appreciation. So use cases of why homeowners are attracted to it is they can use it to reinvest in home improvements. They can use it for event-based expenses, a child that's going off to college where they want to actually tap into their equity and use it. They want to make put on solar or ADU installations, or maybe they do have some other high interest rate debt that they'd like to extinguish. So what are the benefits? It gives them debt-free access to their home equity. They don't have any monthly payments or interest expense. There's no restrictions on how they can use it, and there's no credit impact. It doesn't hit their credit report because it's not a debt instrument. And they retain ownership and equity upside in their primary home. So why are the homeowners now realizing and choosing home equity agreements? There's $11 trillion tapped in home equity today, and they can now tap into that equity. We all know over the last couple of years, we've seen a very high rising interest rate environment. Many people have their mortgages locked at 3%. They're unwilling to kind of refinance or really even sell their home. And so they're kind of in this trap situation where they have that wonderful low mortgage rate, but they're staying in their home and they have equity that's building up. It's a non-debt alternative. So unlike the HELOCs or the cash out refis, it provides liquidity without new debt or monthly payments. And as affordability constraints are growing, homeowners are increasingly seeking some alternatives to kind of traditional credit sources. So I'm going to give a quick example here. Because at this point, people go, okay, this sounds a little bit too good to be true. I can get cash for equity in my home, and that is the basics of how it happens. I don't have to make monthly interest payments. So in this example, let's just take $1 million valued home, and the equity that the cash that the homeowner is taking is $100,000. That's 10% of the home. What we do apply is what we'll call an exchange rate. So the exchange rate is 1.85. So you take the 10%, you apply the 1.85, and what HomeShares NADA is really taking is an 18.5% stake. So I think now everybody's probably doing that math and saying, okay, in exchange for the fact that they don't have any interest payments, they don't have any debt that's being added onto the home, they are giving up a little bit upsized percentage stake in the home for that cash that they're receiving. So really, when the homeowner is looking at doing an HEA, there's an entire eligibility process, just the same way that homeowners go through a mortgage application process. We use a mortgage actually based system here. They have to have a minimum of a 580 FICO score. Even after taking the equity for the home equity agreement, they have to maintain a minimum 25% equity in their home. The average homeowner that's taking HEAs today has on average about 52% equity already in their house. So combine the home equity agreement plus their existing debt cannot exceed 75%. Minimum home value has to be $200,000. They go through and they receive an offer. We'll do up to 30% of the home value in a home equity agreement. And then in exchange, we take a lien secured 10-year term. So we actually take a secured lien position in the home. They don't have any monthly payments. We make the funding to the homeowner. They retain full ownership. We then are now partnering with them in that future appreciation. And investors in exchange are gaining exposure across the country to fractional ownership in owner-occupied homes. And that's a really important point because people traditionally think of rental incomes and investment properties. That's only about 20% of the fund value is actually investment properties. 80% are owner-occupied. And so we are taking it kind of aligned with the homeowner to build further appreciation in their home. So when they sell, refinance, or they buy back the equity stake, the investor now takes a return on that appreciation. So what are the mutual benefits? We spent a lot of time talking about homeowners. Let's now flip it over to what does it mean for investors? So the homeowner keeps full ownership and control of their home. In exchange, the investor is now participating in residential real estate without having to fully own the property or without having any management requirements. The homeowner can use the funds for home improvement, as we mentioned, and about 60% of our homeowners are doing that. They're using it for home improvement, which is great. From an investor perspective, we're seeing an increase in asset value that's leading to a greater ROI. There's no impact for the homeowner on their existing mortgage rate. They can continue with that locked-in low mortgage rate that they've got on their primary. And then for the investors, their returns are now tied to the home appreciation, not to current income that's impacted by higher debt service coverage. So why are HEAs a solid investment opportunity? I kind of think of these are the biggest, 4 largest downside protection. I just talked about that exchange rate that we put in place. So if you model that out, a single home would actually have to depreciate over 45% for there to be a situation where there's a loss of money with an HEA. These are owner-occupied properties, so there's greater long-term appreciation than there tend to be in short-term rentals. It's a passive investment model. Again, no active management of a property. I talk to a lot of investors who say, I've done rental incomes and it's such a headache. It's, I'm managing the properties. I'm having to deal with that ongoing expense as well as time suck. There's no need to actively manage a property or the expenses associated with it. There tend to be strong risk-adjusted returns, 14 to 17% IRRs, and structured downside protection. So here's the real-life example. I'm going to give an example of a home here that, again, has $1 million home value. They want to take $100,000 out that goes to the homeowner. We take the 18.5% lien secured stake in the home. It, let's say, appreciates, and this is just a kind of a pretty conservative amount, but let's say it appreciates 4% annualized over 5 years. And the average homeowner actually stays in their home on average about 5 years before there's a turnover. So the HEA the actual payoff amount when the homeowner is selling their home after those 5 years is $225,145. So it gives a 17.6% IRR unlevered and a 2.25 on the equity multiple. At this point, people are probably asking, so how does that compare against public REITs or other real estate investing? And I like to first talk about the downside protection, because as we know with public REITs, they tend to be tied to market fluctuations and correlated to the markets. The returns over the last 5 years have not been advantageous for REITs, whereas HomeShares, we were seeing kind of 14 to 17%. I'll talk a second about the realized versus unrealized returns. Again, this market correlation, having that low correlation to public markets, especially as there's volatility. And then from a property maintenance perspective, the REIT bears all the costs. Here, the homeowner is responsible for the costs associated with their home, and the investor never has to bear that cost at all. There's a high sensitivity interest rates, as we know, with public REITs, and there's really no direct impact at this point. If anything, as rates might come down, if you will, homeowners might be in a situation where they do want to actually refinance or they do want to pay off sell their home and get into another home. And so in that case, it creates more realized returns for our investors. There's no operational complexity. It's a streamlined passive structure. So let's pause here for a second. I always like to kind of have a little audience participation. And so 2 big questions. How much wealth do you think is trapped in home equity today? And the second one is, how much has that wealth grown in the last 10 years? So think about that for a second. If you want to throw it in the chat, we'll see what you think. It's kind of a big guess, but we'll let you think about that for a second. So it's $34 trillion that's trapped in homeowner equity today. I mean, this is a huge number. This is larger than the US GDP. And it's not a big surprise, right? I mean, you look at residential market, the total value is $47 trillion of the US residential market. And it's grown by $20 trillion in the past 10 years. When you think about, as we came out of the great financial crisis of 2008, we think about, what's happened since that time, and interest rates at all-time lows, as people have become more homeowners into the market, as they've built equity in their homes and stayed in their homes, they've grown that equity portion. So it's obviously, this is a huge opportunity, not only for the homeowners, right, as we talked about, to tap into the equity that they've built up, but especially for the investors to now participate in what I'd call fractionalized owner-occupied equity across the United States. So as I mentioned, Daniel, earlier, we are the only ones in the market. I always like to say that's a blessing and a curse. It's a blessing that NADA had the foresight a couple of years ago to say, let's be the ones out there offering this to individual investors. The curse is it's on our shoulders to help educate the market about this opportunity. So option 1 has actually occurred over the last couple of years. Institutional investors like Barclays, Nomura, KKR, Blue Owl, these are all kind of everyday brand name large institutions. They've had exclusive access to this asset class. So they're the ones that are out there. They've deployed over $2 billion into home equity agreements. And when you think about that, when you actually put that in size, $2 billion is, while it's big, is still small when you look at the overall mortgage industry and how much billions of dollars is in mortgage securities today. So the good news is we're still in the early days of this industry. And it's also what's happened in the last 2 years is there's actually been over $1 billion in rated securitizations. And we all know when the rating agencies get involved, it gets pretty interesting because now it becomes a tradable asset. And so option 2, as I mentioned, we're the first and the only fund that's out there today giving individual investors direct exposure to a pool of home equity agreements across the markets. So the advantages, and I'm excited today, and I should have started this way, Daniel, but we are launching our new brand, and I'll talk in a second about our past brand, but NADA had created a brand 2 years ago called City Funds. And we created Reg A's and Reg D funds to allow people to invest directly into specific cities. And so we gained a lot of experience across 9 different markets by having those funds. And we learned a lot during that time. We have over 3,000 investors in those funds, and we heard loud and clear from them. They loved the ability that they could invest in Austin or Tampa or Dallas or Phoenix, but they said, I'd really like a diversified pool across the United States. And so now we're rolling that up into what we're calling US Home Equity Fund 1. We're about 1 week away from the public launch of that fund. And we're now, just for today, opening up HomeShares.co. And so this is going to allow, we've got a $5 million pipeline right now of HEAs. We've got a team of licensed originators that are out talking to homeowners every day. And so on day 1, we're going to have a strong pipeline of assets that will be added into the fund. We've got over a decade of experience in real estate and mortgage lending. Sundance Brennan, who's our VP of Acquisitions, had leadership roles at Quicken Loans and other major mortgage companies. He runs the team of originators. They're all mortgage licensed originators. We focus on diversified target markets. So we focus on large kind of real estate markets across the United States, tend to be secondary markets, the Tampas of the world, the Miamis, the Austins, Dallas, Phoenix, high growth markets, tend to find good home ownership percentage as a percent of the total market in there. And we use proprietary data and other market insights that drives our investment decisions. So like a lot of funds, we take it very seriously. We have real-time insights into the portfolio. We do reporting and performance tracking on a quarterly basis. We actually are regulated and are compliant. We work with broker-dealer partners. Our investor relations team is all licensed. And we have also, because we did Reg A offerings, we actually worked with the SEC on the Reg A. It's never a fun process, but it actually builds a lot of DNA in the team in terms of how to run a kind of a formal investment process and investment fund. I'd say the U.S. Home Equity Fund is really well tailored for investors that are seeking stable appreciation with long-term kind of wealth creation in mind. So as I mentioned, we've got a track record. It goes back a couple of years. We've done today across those funds, city funds, and our selected yield fund, we've done over 250 home equity agreements. The total gross value of those assets is over $83 million. We've have an 18.9% weighted average IRR on the HEA asset appreciation of those total assets. And we've had over 3,000 investors on the platform that have invested across those funds. We have 4 active HEA funds currently under management. We're covering 9 different states, and we're actually in the process of opening up several other states right now. And we show a 21% IRR on the weighted average IRR on the realized payoffs. So we've actually had about 10% of the portfolio that's been fully realized, meaning assets that have gone full cycle. The homeowner either refinanced or they sold their home and it's been paid off. We've got over $15 million of assets under management. And so that's a little bit about the track record of NADA as a company. And at this point, I will stop. I stayed within our 30 minutes, Daniel, to leave plenty of time for Q&A.
All right. We do have quite a few questions here, and so I'll just start going through them in order. Can you hear me, by the way?
I can hear you. Yes.
Okay, perfect. Jeff is asking, how long must the homeowner stay in the home before selling? Is there a minimum amount of time? I guess not, because the investor is taking 8.5% on day one.
Correct. There is not a minimum or a prepayment penalty or anything like that. So that's a great question. If the homeowner in 6 months after taking out their home equity agreement decides that they're going to do a big refinance, or they decided that they're going to sell their home, there is no restrictions on that.
Jake is asking the question, and it's perhaps a little negatively phrased, but oh shoot, I lost it, and I just lost a bunch of other questions too. 1 second, let me get Jake's question back. Here it is. It seems a little like loan sharking, not to be negative. Is there essentially an 85%-ish vigorish on the front end? I'm not sure I quite understand that.
Yeah, I don't quite understand the vigorish.
Okay.
It's not, yeah.
Yeah, maybe Jake, you could clarify that a little bit, but do you want to address the statement that it's a little like loan sharking, I suppose? What would you say to someone who said that?
I guess, these are an innovative new type of asset, right? It's only, as I mentioned, there's been about $2 billion. But, you've got major institutions, first off, that are participating in the asset class. It is, again, CFPB and other agencies have been, reviewing this. There's formal conferences, actually. The home equity investment conference was just put on by IMN last fall in Austin, when you had all those institutions participating on panels. So I don't know if it's real. I mean, I wouldn't call it loan sharking. It's an opportunity for, again, homeowners to not have to, take out a second mortgage, to be riddled with more debt, to have to, make an interest payment, or maybe a high interest payment on that debt. And it might not be for everybody, right? I mean, there is, as I showed in that example, they have to be willing to give up a little extra percentage of their home. We do actually cap the percentage increase at 18% on an annualized basis. So, there are lots of laws, as you know, with credit cards as an example. There's laws around, the high interest rate that they can offer. And so we actually, even though it's not regulated by the industry today, we actually cap ourselves.
Okay. I think that answered Ains' question as well. So I'll move on to Rajesh, who's asking, what happens in the case of a default or a loan foreclosure?
Yeah, that's a great question. That's something that, as a fund, we obviously we look at, and as an originator, we look at our loan ratio, our loan loss ratio, right? And so, knock on wood, across those 250 assets, we have not had any foreclosures. We've actually had a situation where it had to be worked out, and so we actually work with the primary bank that holds the debt. And we'll actually work with the homeowner to find out if there's other financing options to keep them out of a foreclosure situation. I think we'd all agree, it's usually best to keep the homeowner in the home. Figure out, both the bank as well as ourselves don't want the homeowner to lose that home. We would like to see how they can work that out. If there's other opportunities to, take on some other form of a loan for them, or rework that loan. If there was a full foreclosure, let's just say, worst case, or again, a short sale on the home. In this case, not because we do take a lien on the home. And let's say we're behind that primary debt, we would get paid off after the primary debt gets paid down.
I assume that these would also apply to the question of what happens in the case of a disaster where the house is lost.
Yes, and actually that's a really good question, because when we do the underwriting process, much like a mortgage, we do require homeowners insurance. We do, again, taking that second lien is really important that all of that is in place. We do pull title and things like that. So, we would have coverage and be on the insurance policy as well as a second lender.
Okay, Jeff is asking about, are there any rating systems? He specifically mentions S&P, but are there any rating systems for the fund?
They actually just started, not for our fund, but the rating systems actually for home equity agreements. The rating agencies have actually just gotten involved in the last 18 months. And so they started to produce some reports. Actually, they have DBRS, I think, which is Morningstar, has produced one of those reports, and there's been a couple other rating agencies as the assets have started to move towards securitization. So you won't find them on the public markets, but the rating agencies are involved in and written reports as well as rating these assets. That's a great question, and as we think of Home Equity Fund One, part of the exit strategy is a securitization.
Darshan is asking, and this is educational talk currently, but go ahead and answer these questions anyway. Darshan saying, is there a minimum investment and time frame? What are your fees?
Yep. So minimum investment is $25,000. We are, as I mentioned, this is a little early. We're launching it next week. HomeShares.co is open right now. So if you go there, you can sign up, and that way you're first to hear. But when we launch the fund next week, it'll be open for a 12-month period for investments. And the fees are 1.5% asset management fee, and then 15% carried interest. So 1.5, 15 is the split.
Okay. Travis is asking, do you have data on the credit score distribution of homeowners using HEA funds?
We do actually. We track across all the 250 assets that are in the fund across our portfolio today. The average credit score, FICO score, is 620.
All right. And I know this person here, Jack Aldridge, is asking, are there any areas where you have properties in? Is there any areas that you do not go into? Why?
Good question. So yeah, there are the areas that where we do have properties. Again, are the cities that we launched our city funds in, and so those are Miami, Tampa, Houston, Dallas, Austin, Phoenix, Los Angeles. And I will actually that question about homes burning down. Obviously the devastating thing that happened in LA. One of the things our originations team does right away is obviously make sure our homeowners are fine. And we were very fortunate our homeowners that none of them were even in the evacuation zone. So anytime there's those things. So those are cities, but we also are outside of just those cities that we were in. We had another fund called Select that allowed us to go outside of those cities. So we've invested in Charlotte, in Philadelphia, in other cities like that. I wouldn't say today, Jack, there isn't any area we don't go into, but our team focuses on 9 key states. And as I mentioned, we're starting to open up other states.
All right. And this is kind of I don't think we've had a question like this before either, but Jeff is saying, I assume you have competitors. What do you bring that others do not? And I think go ahead. I think you may have answered this.
Yeah, so it's I think as I mentioned in the beginning, this is a new asset class, and there are 5 other major players out there that are originating home equity agreements for homeowners. And yeah, so I think you could say, yeah, you're kind of competing against those other originators. It's such an enormous market right now that I think our acquisitions and origination team would rarely actually bump into competitors. We actually have affiliate partners, solar companies and home improvement companies that are bringing us into the homeowner, right? Because the homeowner's talking to them about, let's say, adding solar, and then they're saying, well, how do I finance it? So we're fortunate is that we've got great partners. That is actually the direct source of most of the homeowners. And then on the investment platform, again, we're the only ones out there in the market that have gone out and decided to make this asset available to individual investors. Those other 4 players I was mentioning on the origination, they went out and raised money from the large institutions that I mentioned earlier.
Okay. And Brooke is asking, how do you find the homeowners?
Yes, that's a great question, and I must have known it was coming. So 70% of our new homeowners are coming from affiliate partners. As I mentioned, solar companies have been a great source of that because you could be 30,000 to 50,000, maybe a little bit more, depending on the size of the home. And a lot of times when the solar company's talking to the homeowner's going, gosh, now I've got to dip into my savings, or gosh, I have to take some debt to pay for this, and I'm gonna have to make monthly payments. And the solar company will say, actually, if you've got equity built up in your home, you could tap into that using a home equity agreement. And obviously, if you're building and putting solar in, you're probably going to stay for a few more years. And so it's actually a really nice partnership, those types of partnerships. The other 30% is, we do some general advertising on Facebook and Google and other places. And so we get direct leads from the advertising that we do to directly target it in those cities that we focus.
Okay. Jake is asking, do you get local realtors on your network to have people live and check the properties? I'm asking because I'm a realtor.
Well, that's interesting. So I'm sure we do have realtors on our network and when he says to have people check the property, to actually go out and do an inspection for us. We don't use the realtors to do inspections or anything like that. We actually do contract with third-party inspection services. So we actually do get inspection reports. but we use third-party inspectors for that. And then we actually use an outsourced market valuation service to help determine the kind of the market value for the home, which it has to be an agreed upon value with the homeowner too.
All right.
That was a
And
good question. Yeah.
Jeff is asking another question. Does the fund go out and resell any of the exposures to others, like hedge funds?
So we don't do that today. That is part of, again, the plan for U.S. Home Equity Fund is to actually to sell, a securitized pool of assets.
Okay. And it looks like we went through all the questions there. We hit them pretty quickly, I think. Got through a lot of questions. If you have any other questions, feel free to put them in the chat.
And then also, if we could throw up the slide one last time, I've got the last slide. Just people always say, Tor, how do I reach
your
you?
contact information, of course.
Exactly. So as I unveiled here, HomeShares.co just launched for Alternative Investing Club. It's our soft launch. You can contact me directly, but you'll also scan this QR code, and it'll take you right into the offering itself. Again, I love spending time with people because this is many times the first time they've heard about home equity agreements. And sometimes you'll hear people that are interested from an investor perspective, but then also from a homeowner perspective, they start thinking, maybe I should consider this as well.
All right. Let's see. Do we have any other questions here? Oh, one more question. What happens if the home loses value?
So that's a good question, and that is actually why we have that built-in downside protection by taking at the time that we actually provide the cash to the homeowner, we actually have that exchange rate of 18.5% on the percentage that we've invested in. So we've actually taken, and that's in that lean position, we've taken an outsized kind of or upsized percentage into the home to help against that downside protection, because we know that homes will appreciate and they'll also have some depreciation. So we want to protect the investors in that case, and the homeowners understand that. Again, everything they get an entire disclosure package, just the same way they would with mortgage. Our team is as actually licensed mortgage originators. They all carry their license. They come out of the mortgage industry. And we use an entire kind of processing system that actually provides an entire package to the homeowners that they go through and understand, kind of what happens in those types of cases.
All right, we're getting more and more questions in here. They're starting to pop in again. Jake is asking, how are investor returns paid out?
It's a good question. So it is important to look at this as not a more of a growth fund than a kind of quarterly dividend type of fund. So we do reserve the rights to make distributions, but the idea is to get your returns on the capital appreciation of the fund. And so I like to mention investors should have a 5-year kind of horizon that they should be looking at. The investment strategy is actually in the 2 to 3 years of this fund to perform that securitization. So at that time, investors would get those returns paid out. And then, as I mentioned, as we get realizations, we will be looking at that against the current needs of the fund and making distributions as appropriate. But I always like to say, Daniel, like those kind of questions, I'm like, don't go in expecting it's going to be a specific return, on a quarterly, like a dividend type of basis. As we do have realizations and we do have that come in, it can get dispersed. It would be, on a quarterly basis, those distributions made.
Okay. William's got an interesting question here. If the homeowner buys out the HEA, does the investor get the same returns?
The buys out.
So,
yes. Yeah.
Yes. Okay. Easy answer. All right. Let's see. We've got, this is another good question from Anita. Do you accept agreements on people's rental properties? So the question, I assume, is, do you only work with lived-in owned residences, or do you also work with rental residences?
We do work with rental properties as well. For U.S. Home Equity Fund 1, from an allocation perspective, we'll do up to 15% of the fund will be allocated towards rental or investment properties. But 85% of it will be owner-occupied, non-rental properties.
I know you mentioned that this is a growth fund, but AA is asking, what is the average time frame to get the return on the investment?
So it would be 5 years, but we are in the prospectus and we are sharing with investors. We would expect that with the securitization within 2 to 3 years.
Okay. Jake is asking, what would motivate a borrower to do this rather than a HELOC?
Yeah, again, I think it's the cash flow or the freeing up the, not having to have a cash flow impact by making monthly payments against it, not having more debt against their, it's not a debt instrument, it's an equity instrument. So not having additional debt against their home or even showing up on their credit report, right? This is not, again, since it's not a debt related or any interest payment or any kind of payback on it until they sell or refinance or choose to sell off the HEA.
All right. And MM is asking, what are the minimum and maximum amounts that a homeowner can borrow? What are the stats on what people actually do borrow?
Yeah, so the max that they can borrow is 30% of the home value. And the other cap is they have to maintain, after we've given them that home equity agreement, they cannot have more than 75% combined loan to value, meaning our cash that we put in plus any debt they have. So again, back to they have to keep 25% equity in their home. So that's really the benchmark that they should be thinking about is, again, we won't do more than 30% of the home value. So if the home's valued at $1 million, we wouldn't do more than $300,000. So there is a natural kind of threshold there.
All right. And I'm not going to.
Our average today is about $100,000. So we've seen that as these have become more familiar, homeowners have actually grown the amount that they're taking out. So unlike the HELOC as well, it's not tied to a specific thing. So a homeowner many times might say, I'm going to use it for solar and I'd like to take some more out because maybe I have my student going off to college and I could really use it to help pay for some of those college expenses.
Okay. I'm going to skip Darshan's question because he's asking you to make specific projections about the fund's returns. But Darshan, go feel free to have a conversation directly here. I'm going to go down to JM. Can the homeowner prepay and I'm sorry, I meant to go to Bentley next. Where do homeowners go to offer up their houses to an HEA?
Where do they go to
So how can they get an HEA? Basically, is what he's asking.
So yeah, it's if they go to nada.co today, on that site you'll see an ability to apply directly. And so again, the beauty of our company Nada, we've got the two sides, and over at nada.co you can find the homeowner experience in terms of applying for an HEA.
All right, next, I think this question has been answered, but we'll just reiterate it really quickly. Can the homeowner prepay and close the loan? If so, how does it affect the impact to investor returns?
They are able to prepay. There's no prepayment penalty. They can do that any period of time, and it should not have a material impact because of, again, the equity exchange rate that we start from day one.
All right. That's all the questions we have here. So thank you, Tor, for coming in and speaking to the Alternative Investing Club. Oh, it looks like we're getting a few more questions in here. What do we have here? Oh, where did your name come from? Where did the name Nada come from? Is it because it's from nothing in Spanish?
Well, I cannot claim that I came up with it. John Green, the founder, and Mauricio, other founder, a few years ago came up with it. And part of it was they came out of the mortgage industry running innovation and strategy for larger mortgage companies. They were really intrigued at this ability to bring new consumer finance products for homeowners. And so the idea was, can we give homeowners this ability, again, to not have to make any payments, making interest payments and things like that. And so that word "nada" was used as a way to kind of like represent that idea for the homeowners, right? Because in the beginning, very much needed to get homeowners understanding the value of what an HEA could do. So the idea was, hey, you pay nada.
All right. Could everybody put into the chat, since we can't take everybody off mute, to thank the speaker for coming in? And I always loved hearing all the 80 or so thank yous at once. Go ahead and put in the chat, thank you for coming in. And I'll just thank you verbally for all of us, Tor. Thank you for coming in and sharing with the Alternative Investing Club. If you're interested in NADA, the contact information is there. And you want to take one last question? Every time I sign off, another question pops up. Here we go. We'll do this one and then we'll end it. How do you ensure that the property does not have some legal issues or claims?
That's
there come the thank yous.
Great question. So our originations team, as they run the process much the same way a mortgage is run, they do actually searches, right? They do pull credit reports. They do any other filings. So the house has to be free and clear. Just again, hats off to our team over there on originations and how thorough an underwriting process that they run. Again, they pull inspection reports. All insurance has to be up to date, and we get added obviously as a second lien position there. So it's a similar thing of any liens or claims against the home or any legal action that would be rooted out in the underwriting process.
All right. Thank you, everybody. Thank you, Tor.
Thanks for having me, Daniel.
Yep. We'll see everybody here again next week, Friday at noon, Pacific time.